Today we look at accruals and prepayments. What are these accruals and prepayments? We've got a standard IS1 which requires that when preparing financial statements, these should be prepared on an accruals basis. The meaning is that transactions and events are recognized when they occur and not when the cash is received or when the cash is paid out. By recording when the events actually or the transactions actually take place, then they'll be recorded in the accounting periods and reported in the financial statements of the period to which they relate. So we'll start with an accrual first. Accruals are expenses which have been incurred by the business during the accounting period but have not yet been paid for. So for example, if your rent is due on the 30th of October, you reach 30th of October, you've not paid your rent. As you move into November, then you need to show an accrual for that rent of October. In this example, we have Fred, who prepares accounts 31st December each year. On 1st January 20X8, he pays a telephone bill of 60, which relates to the period October to December of X7. Although the payment does not go through the cash book until X8, considering that the payment was made in January and the payment was for a period covering X7, the expense must be included in the accounts for the year ended 31st December X7, since it was accrued, it was incurred in this period. The opposite is true where a company pays in advance for an expense which does not incur, yet this is known as a prepayment. So prepayments will arise when expenses are paid for in advance before they are used. To illustrate, we have Fred, who pays for insurance for his business on 20 December 20X7 and pays for the period, for the 12 months commencing January 20X8. Although a payment is made in 20X7, the expense should not appear in the 20X7 accounts because it relates to the period 20X8. Instead, in the accounts for 20X7, we show an asset or a prepayment for the full amount of the insurance costs. So how do we treat these accruals and prepayments? For accounting purposes, the accruals, being an expense, will debit the income tax expense and credit an accruals account which will be in the statement of financial position. On the other hand, for the prepayment, we're going to debit a prepayment which will be an asset account in the statement of financial position and credit an expense account in the income statement. Note that this is one of those rare instances where the expense account is debited. As you will be aware that an expense account has got a debit balance. In the statement of financial position, the accruals will be under the caption of current liabilities. The prepayments will be under the heading of current assets. Let's now illustrate this in a question. You've got Fiona, who sets up a business on 1st January X7. Her cash payments for the year to 31st December are shown below in the table. So you've got two kinds of expenses, electricity and rent. You're given the dates when the rent was paid and for the period in which what was paid for, and the same for the electricity, the period paid for and the dates when the payments were made, including the amounts. We have a note which is after the year end, in which Fiona received an electricity bill of $168 for the quarter to 28th February X8. We are required to calculate the expense incurred by Fiona for electricity, for rent for the year ended 20X7. B, calculate the amount of any accruals prepayment at the end of the year. C, state the general entry required for the year-end adjustments. So start with electricity. Now, before we look at the solution, let's emphasize a few points. When you're accruing expenses, when you're recording expenses for a financial year, make sure that you have 12 months in total, 12 months of expenses reflected in total. Establish whether you've got 12 payments as well for those 12 expenses. If there's an expense which has got no payment, then that expense should be accrued. Equally for the prepayments, make sure that you've got 12 months of expenses which you are paying for, and ensure that you've got the actual 12 months payments done. If the expenses you are paying for are 12 months, but your actual payments are more than 12 months, then the excess over the 12 months is a prepayment. So ensure that you count your months correctly. Establish the reporting period. The reporting period is a 12 months in which you are reporting. In this case, our reporting period is January 20X7 to 31st December 20X7. So we want to ensure that we have a payment for each of those 12 months of X7. So on 10th March, we paid $96,500 for 2 months to 28th February 20x7. 2 months to 28th February x7 will start from January x7, February x7. So we see that this payment was made for expenses in our current reporting period. We made another payment on 12th June x7 for 120, covering a quarter to 31st March. Quarter to 31st March will start from 31st May rather. Quarter to 31st May will start from March, April, May. That gives us another 3 months. So we have 2 months paid for in March, 3 months paid for in June, another 3 months paid for in September, and another 3 months paid for in November. So 3 gives us 9, plus 2 gives us 11. So there was no other payment in 20x7, but we have December of x7 which has not been catered for. If we check in the notes, the payment in March of x8 covers a quarter to February x8. Quarter to February x8 will start from December, January, February. The December is part of x7, so we need to accrue 1/3 of the 168 to December. So that's what we are seeing here. There's a missing expense for December, so 1/3 of 168 gives us 53. So the total expense for 20x7 is supposed to be 251, so 521, but we've only paid 465, so this 56 expense for December should be accrued for. We move to the rent. On 1st February of x7, we paid rentals of $375 for 3 months to 31st March x7. Now 31st March x7 starts from January, February, March. All 3 months are within our reporting period, so we need another 9 months to cover the expenses for 20x7. But in April we paid $1,584, but this $1,584 was for 12 months up to March x8. 12 months plus 15 months gives us 12 months plus 3 months gives us 15 months. So we see that we've got more payments in 20x7 than the number of expenses in 20x7. So the 1584, we need to take out 3 months, which we have here. 3 months which will be covering January to March x8, which equals 396. So we subtract that to give us our total expenses for 20x7 as 1563. But since our payment was total payment was 1957, the 396 is a prepayment, which is an asset. So the landlord is owing us that amount. So our entries will be to debit electricity expense for the accrual 56, credit the accrual in the statement of financial position of 56. Then for the rentals, which was a prepayment, is to debit the prepayment in the statement of financial position of 396 and credit the rental expense in the income statement of 396, being a prepaid expense as at 31st December 20x7. Now at the beginning of the year, the accruals and the prepayments should be reversed. So the entry to reverse the accrual will be to debit the accruals in the statement of financial position and credit the expense in the income statement. The reversal for the prepayment is to debit the expense in the income statement and credit the prepayment in the statement of financial position. So the approach that you need to take when you're answering a question is a 4-step approach. So step 1, you reverse the opening accrual or prepayment. Then you post now the transactions which are happening in the current year. Post the cash paid during the year, post closing accrual and prepayments, then balance off your accounts. So let's demonstrate in the Fiona question again. We are now in 20x8 and Fiona paid the following electricity bills. Remember, there was an accrual of 56. That 56 which was accrued in 20x7. So during March, Fiona received an electricity bill of 186 for the quarter to 28th February 20x9. We're required to calculate the electricity expense and accruals for the year ended 31st December 20x8 and to complete the ledger accounts. So reverse the 26, remember the 56 rather, where the credited accruals 56,000 being accrued for the month of December. So the accrual will be reversed by crediting the expense account and debiting the accruals account, and then we post now the cash received in the year for all the quarters of the current year 20x8. We notice that the last payment was done in December, but it was for the quarter up to 30th November 20x8, meaning there's one expense for December which has not been paid for, This was included in the invoice received in February. So we'll get 1/3 of that 187 being the accrual for December X8 as the closing balance. Which we have here, 1/3 of 187, 63. That gives us the accrual for 20X8. So what we take to the income statement for 20X8 will be the expense of 585. Then in the balance sheet we have an accrual carried forward of 63. Let's look at one more example. Jimco prepares its financial statements for the year to 30th June each year, meaning our reporting period will be 1st July, X6, because we're looking at we're looking at 30th June X7, so our reporting period will be 1st July X6 up to 30 June X7. The company pays for its insurance quarterly in advance on 1st March. So the one paid we're paying quarterly in advance in 1st March, 1st June, 1st September, and 1st December each year. The annual insurance premium was 24,000 until 31st August 2006. After that date, it increased to 30,000 per annum. We'll continue the solution in the next video.